Hello. Do you own mutual funds? If you own funds, chances are you have them in your 401k or you have them in other accounts. One of the things that I find that is so annoying this time of year, especially, is you have to watch your statements because if you own mutual funds, what can happen is you will see capital gains distributions and dividend distributions that are done at the end of the year. Now, normally you would say, well, this is great. I have a distribution that goes into my account, or maybe it's reinvested into these mutual funds. Isn't that a good thing? Well, it can be an amazingly great thing. But there's something called the phantom tax that's really, really annoying. So you probably, if you're like most people, don't even know it exists. So I thought I would just explain what this phantom tax is and talk a little bit about mutual funds and why I'm not a huge fan of them. So let's start off with what happens with these capital gains distributions. So as you know, there's a portfolio manager in a mutual fund that is managing the stock and bonds within your portfolio. And throughout the year, they're buying and selling, and they are going to take gains or losses. And one of the things that can happen is you can actually have gains that are paid, you pay taxes on that you didn't even earn those gains. That's what's called a phantom tax. And let me explain how that happens. Let's just do a hypothetical. Let's say before you bought a mutual fund years ago, that the portfolio manager bought, bought Apple. And they bought Apple at $50 a share, say. And then Apple went up to $100 a share before you got in. Then you get into the fund. You got into the fund when Apple's shares were at 100, right? Now, let's say now that Apple's stock comes down a little bit and now it goes down to 75. So from the time that you got in, you actually have a loss in Apple, right? You didn't even earn a gain in Apple. But from the beginning of when the fund actually bought that particular stock, they have a gain. Now, let's say that portfolio manager decides to sell while you own it. Now they're going to distribute a $25 per share gain to you, even though you have a $25 per share loss. This is extremely annoying. So if you look at mutual funds, there are several things that make them challenging in the long run. And if you, when you start building your portfolio to a significant amount, it's a good idea based on how we look at things to just graduate from using mutual funds. Sometimes you still want to use them in certain cases, but in a lot of cases you can graduate from that and have your own personal mutual fund by owning the stocks and bonds directly. So this time of year, this becomes very, very obvious because you see those gains and we see those phantom taxes that are generated to clients that have had mutual funds. Now we generally shy away from them. But let me talk a little bit about some of the other potential pitfalls of mutual funds. There's some benefits, but I really want to focus in on some of the reasons why we don't like mutual funds. So we talked about the phantom tax. The next thing I'd like to talk about is the fees. So when you're dealing with a mutual fund, obviously there are fees, and a lot of times you don't see them. People don't see what's happening in there. But basically you've got your expense ratios, and that's just all the expenses. And some of these funds have low expense ratios, but many of them don't have low expenses. So those are not really generally seen, but it's taken out of your value. So those fees will come out. And then the other times you might see 12B1 fees, or you might see really one fee that's in there that people really don't recognize is the fee from turnover. Because every time you have a turnover in the portfolio manager is selling and buying, there's a bid-ask spread that is paid, or even commissions like a certain percent or a certain cents per share that is embedded in the fund. You don't see that cost, but it's there. It's a very real cost. So the other thing that I would consider it a cost is that many of these mutual fund managers have portfolios that are so enormous, billions upon billions of dollars, that they cannot buy the stocks that are the most attractive. They can only buy the bigger stocks, because if they take a meaningful position in the stock that's too small, or that's a mid cap or a smaller company, they really move the market. They cannot be nimble like you and I can. So we're managing millions of dollars as well, but we're not, you don't have $1 billion portfolio, right? So you can be much more nimble with your entry and exits of your portfolio. And these portfolio managers in the mutual funds cannot do that. If they initiate a position, they might have to do it over a month, or they have to look at the average volume, and that really has a big impact. So one of the ways that they get around this is they do what's known as closet indexing. They basically own so many securities. They'll own 200 securities or 150 securities, just because they got to keep that money working. And whenever you get past 50 securities, 100 securities, you're acting so much like the index. You're basically closet indexing, and you may be paying fees for active management, but you're really getting an index. So that's a real problem with these mutual funds. So for a lot of reasons, I don't particularly like mutual funds. Sometimes they're fine, and in some cases they make a lot of sense. But it might be time for you to graduate from mutual funds and own your own personal portfolio. And the other thing I like is that when you own your own personal portfolio, you can differentiate from owning the index, and you can own those stocks that are the most adaptable to new technology and innovation. They have more desirable products and services, and that their performance looks much more attractive. So if you have a lot of mutual funds, take a look at your statements, watch your statements, and see what's going on there. And as always, if you want to ask us questions, let us know. You can go to talktolouisyanis.com, and we will do a free analysis of your mutual funds, if you have mutual funds, to let you know what those fees are, what those turnover numbers are, and how that could be doing well or not doing well, and just get the facts. So anyway, mutual funds can be a great thing. They can also be a bad thing. So just to make you aware, I hope you're having a good day. By the way, there's a lot of talk today. Today's a crazy day because there's tons of talk about a particular stock that's being moved up very abruptly. GameStop. A lot of retail investors have been pushing up the stock to squeeze short sellers in the hedge fund businesses. This kind of pump and dump stuff and this crazy rule changing, leaving people holding the bag with losses and things like that. This is a real problem, and it's also a sign, by the way, that we're in a market that is much more frothy. And for that reason, it's better to be more selective rather than owning these funds that own everything. All right, so that's all for now. Hope you're having a great day. Louis Yanis, WealthNet Investments, signing off. Talk to you later.